Today we're going to dive into a subject about a little known way that US companies, Americans included, can have a 37.5% reduction in their corporate tax, paying just 13.125% tax. A lot of our clients are Americans, although we have people from all over the world. And so in particular for Americans, there are a whole bunch of anti-avoidance rules. And these are typically subpart F of the US tax code, which generally speaking, we're talking about something called foreign-based company sales income, foreign-based company services income, but also GILTI tax, which came into effect with the Tax Cuts and Jobs Act. Now, at the time, they introduced a participation exemption, which allowed us to go and to have some ability to repatriate dividends into the US tax-free. Very, very commonly, one of the things that we're setting up for Americans is to utilize this thing where you can basically cut the corporate tax rate in half. Now, there's a whole bunch of limitations on whether you can do that or not. Like I said, you have to worry about all these other rules. And the way that you do that essentially is you have a US C Corp, the C Corp owns a foreign company, a bunch of things have to be true. The foreign company makes the money, it pays hopefully no tax, it gets hit with GILTI tax, and so you're at 10.5%. Now, this has got a whole bunch of hassles associated with it in terms of having a foreign company and running the income through a foreign company. There might be a bunch of reasons why you don't want to do that, etc. And so it's worth noting that at the time when they introduced all of this, they also introduced something called the Foreign Derived Intangible Income, FDII regime. And so the FDII regime was set up essentially to allow you to have, in many cases, the same or very similar benefits that you would get from something like this structure that I'm mentioning, but without having to do that structure. And this was relevant because when they introduced GILTI tax, what they said was, say you form a company in another country, you have a subsidiary there, you will get a tax credit against your GILTI tax for 80% of the taxes paid domestically. And so if you do the math, what this works out to being is that if you were to actually have had tax at, let's say, 10.5% or whatever, you basically, you get to the stage where your effective total tax can be up to a little over 13%. And now, the last thing I will say, though, is for people who are not Americans, does this make sense? Often we want to use stuff like US LLCs. This is not a replacement really for that because that's a very different situation. You do end up being hit with dividend withholding taxes, taking the money out of the country. So I would say usually for non-Americans, this is not a great way to go. But if you're an American, then certain businesses at least can benefit quite a lot.